4, and these are the group members: Herald, Sabaha, Chobofelo, and Co. will be presenting on fraud within the accounting and finance profession.
We're taking you through the conceptual framework of CIMA and ethics of professional accountants. The CIMA Code of Conduct is principle-based, not rule-based. This is therefore, it has 5 fundamental principles that guide accountants. Firstly is integrity. Accountants lead with honesty and objectivity, which means accountants are not biased when making professional decisions. Thirdly, professional competence and due care, which means accountants maintain knowledge. We then have confidentiality, which means accountants protect the knowledge they gain from the profession and protect it. Lastly, we have professional behavior. That is, they follow the rules and laws relevant to the profession. To uphold these principles, CIMA has the 3-step approach. The 3-step approach acquires accountants to process the information for business decisions. We have identify accountants, look at the information they have and see if they do not break ethical conduct. In evaluation, accountants use professional judgment to see if the professional judgment does not compromise accountants' integrity. Lastly, we have address. Accountants address the situation by safeguarding the threats either by reducing or removing it till it is accepted by the CIMA framework approach.
Moving on to the common threats of fraud in the accounting and finance profession. Firstly, we have the asset misappropriation, which involves employees stealing or misusing the company's resources. This can include payroll frauds and invoice billing. Under payroll frauds, by people create ghost employees or alter pay rates and fake timesheets to get unauthorized pay. And then we have a real-life situation, which is whereby Nathan Muller, who was an accounting manager at ING Reinsurance Company, who embezzled 8.4 million over 4 years. He created a shell company with a similar name to a legitimate vendor. He was able to cut checks to his company and then go back into the system and code them as real payments to real vendors. Secondly, we have financial statements fraud, which is deliberately misrepresenting financial data to mislead stakeholders. Under that, we have revenue recognition and asset or liability manipulation, which is overstating assets, which includes inventory. We have a real-life situation whereby in 2020, Starbucks of China admitted that a significant portion of their 2019 sales were completely fabricated to inflate its stock price. The employees and the executives fabricated roughly around $310 million in retail deals. Thirdly, we have corruption and cyber-enabled fraud, which includes using influence for personal gain and leveraging technology to facilitate fraud. Under this, we can find AI-powered attacks and BEC, which is business email compromise and phishing. We have a real-life situation whereby in 2016, an Austrian aerospace parts manufacturer became a victim of business email compromise and phishing, whereby a cyber criminal impersonated a CEO by sending an email to an entry-level accountant in the finance department. The accountant wired 54 million to a foreign account. The accountant wired 54 million to a foreign account.
Now we're going to be looking at ethical conflict under the CIMA conceptual framework. An ethical conflict arises when a professional is put under pressure to act in a way that goes against the main principles of the CIMA code. This may be due to professional duties conflicting with self-interest, pressure or intimidation from management, and loyalty to your employer. Okay, so now we're going to look at self-interest. Self-interest is whereby a professional has a benefit personally from a client. This may be in cash or in kind. A real-life example of such a situation was the Satyam Computer Services scandal of 2009. The Satyam Computer Services chairperson admitted to inflating profits and assets. During this period, the external auditors turned a blind eye and approved false financial statements since they knew that they would receive financial compensation in the form of an audit fee. Now we're moving on to mitigation of self-interest. How can we do this? We can reduce financial dependence, have partner and staff rotation, and then have independent review, and lastly, ethical training and culture. Now we're looking at pressure or intimidation from management. This is whereby an employee is put under pressure by a higher up or management in order to act in a way that goes against the CIMA code. An example of this would be the Wells Fargo scandal of 2016. In this scandal, employees of Wells Fargo opened unauthorized customer accounts in order to meet sales targets. This was due to pressure from management, threats by job security, and bonuses. Now, how do we mitigate pressure from management? We could report threats to regulatory bodies, and we could rotate staff. Now we're going to look at familiarity threat. This is whereby a close relationship of the employer and the employee affects their objectivity. An example of this is the Enron scandal of 2001. Enron was a large energy company based in the US that had inflated their profits and assets. But however, due to a long-standing relationship between Enron and their external auditor, which is Arthur Andersen was not able to pick up this wrongdoing. Now we're going to look at a way to mitigate familiarity threat. We have to rotate staff in order to decrease familiarity, increase supervision or reviews, and second opinion from external parties, and also apply ethical frameworks like the CIMA framework.
Okay, so now we'll be focusing on the mitigation strategies and safeguards, more especially targeting asset misappropriation, financial statement fraud, and the corruption and the cyber-enabled fraud. Starting with asset misappropriation, at Cost Company, a senior employee embezzled around $34 million through unauthorized wire transfers and personal payments which were charged to the company and left undetected due to weak controls between 2005 and 2009. However, safeguards such as cash handling, recording, and reconciliations were introduced, as well as dual authorization, and external auditors were also involved in the situation. Now we'll be looking at more of the mitigations that we could do besides this one. We could strengthen the intensity of internal controls, such as including functional separation of routine reconciliation and approval limits for purchases and payments. We could also set up system controls that aid with the avoidance of unauthorized access to assets by safeguarding and building an encryption for major assets that a company has. Then we could also increase the chance of detection by independent audits by bringing up things like surprise cash counts and stock takes, as well as introducing external auditors to the company. As for the financial statement fraud, we could introduce whistleblowing mechanisms which help to prompt reporting through anonymous reporting channels for building protection and safety against rebellion. Then we could have internal robust controls and financial reporting. This could help by the segregation of duties, as well as recording and approving transactions. Then we have professional competence and due care. Under corruption and cyber-enabled fraud, some safeguards could include strong anti-corruption policies, as well as
strong IT and cybersecurity controls.
Our presentation, I'll be taking you through the recommendations. The first point is to strengthen organizational oversight. This can be through improving supervision, monitoring, and accountability within the organization. The second point is to make regular improvements to internal controls. This includes policies that ensure accurate financial reporting and protect the organizational assets. The last point is investing in skills development and competency. This can be improving employees' knowledge and qualifications through training and mentorship.